So Zim released their first quarter earnings and the stock is down 17%. It's now trading at $14.63. The reason the stock price is moving is because the market is still open. It's going to close soon. So they missed earnings by 131%, missed revenue by 13%. Plus they're cutting their 2023 dividend. Let's go through all the reports the company released on their website, the press release, the financials, and their presentation. So this is their press release. You can pull it off their website. For the first quarter, revenue of $1.4 billion, net loss of $58 million, adjusted EBITDA of $373 million, adjusted EBIT loss of $14 million. But they still reaffirmed their 2023 guidance, which is adjusted EBITDA of $1.8 to $2.2 billion. In case you didn't know, they're located in Haifa, Israel. They're a global container liner shipping company. The net loss of $58 million for the first quarter compares to a net gain of $1.7 billion in the first quarter of 2022. When you compare the EPS, it's a loss of 50 cents compared to a gain of $14. Their revenue of $1.4 billion in the first quarter, they had revenue for the first quarter of $1.4 billion. That's down 63% from the same period last year. They carried 769,000 20-foot equivalent units, and that's down 10% compared to last year. They operate massive vessels, and on the vessels are these containers, 20-foot containers. And inside the containers is what they're shipping for their customers. The average freight rate per unit is $1,390, a decrease of 64% compared to first quarter 2022. Shipping rates are really volatile. That's why companies like this are really risky to invest in. You either hit a grand slam or you get hit by the ball and you're out for the season. There's usually not too much in between. Here's a quote from their CEO, Eli Glickman. After a record year of adjusted EBITDA and EBIT generation, Zim's first quarter results reflected the decline in freight rates and weak demand, mainly in the Trans-Pacific trade that began last year. The near-term outlook remains challenging, but we've taken proactive steps to better position ourselves for the future. The CEO also said we adapted our vessel sourcing strategy to improve our cost structure with the addition of fuel-efficient new build tonnage, and that will overhaul our fleet profile. This includes 10 15,000 TEU dual fuel LNG vessels. LNG stands for liquefied natural gas, which are suited for our Asia to US East Coast service, and 36 smaller, more versatile vessels. 18 of those are dual fuel LNG that will enable Zim to operate a fleet best suited for our trades and services. At the same time, our strong balance sheet and ample liquidity makes us confident that the company will operate from a position of strength, even during the current market headwinds. We continue to anticipate positive EBIT in 2023, despite headwinds. He also says we reaffirmed our guidance for adjusted EBITDA of $1.8 to $2.2 billion and adjusted EBIT of $100 to $500 million. Here's a summary of what we just talked about. Carried volume quarter over quarter, 859,000 20-foot equivalent units, down to 769,000. It's really rates that are killing these companies. Rates are so volatile. Look how much rates have come down. Because demand really didn't change that much. Sure, it did come down, but not by that much. But look how much rates have come down, from $3,800 to $1,300. That's why revenue is just getting killed, from $3.7 billion to $1.4 billion. And that's why they posted a loss compared to last year of massive gains. Here's net income quarter over quarter, $1.7 billion, negative $58 million. EBITDA margin, 68%, down to 27%. And free cash flow down from $1.5 billion to $140 million. Net debt is debt minus cash. In December 2022, they had more cash on their balance sheet than debt. Now they have more debt, but it's not too much, only $381 million more debt than the cash. Their total cash position decreased $353 million from $4.6 billion to $4.25 billion. CapEx was $36 million compared to $183 million in the first quarter of 2022. Dividend policy in first quarter 2023 dividend. Zim's dividend policy remains unchanged. The company intends to distribute 30 to 50% of annual net income as a dividend to shareholders. Dividends will be made on a quarterly basis at a rate of 30% of quarterly income. But when you read the next paragraph, it paints a different picture. In accordance with its dividend policy and in light of the net loss recorded in the first quarter of 2023, the company will not pay a dividend to shareholders on account of its first quarter results. Here's their first quarter PowerPoint presentation. This is also on their website. Here's the high level info we just talked about. Revenue of $1.4 billion, down 63%. EBITDA down 85%. EBITDA margin 27%. Adjusted EBIT margin negative 1%. The difference between this and this is a DA, depreciation and amortization. Cash flow from operations $174 million, down 90%. Long-term strategy and priorities remain unchanged. Key strengths: agility, excellence, and innovation. Improved cost structure, operational commercial agility, growth engines. Here's a carried volume, freight rate, and revenues. Free cash flow, cash conversion rate of 38%. I think they're referring to the cash conversion ratio. And the way you calculate that, it's operating cash flow over EBITDA. But I know different companies calculate these ratios slightly differently. It's used to determine the company's cash flows relative to its net profit. Total debt of $4.6 billion, that's up $307 million. Cash is down $350 million. Net debt is up $660 million. You want net debt to go down because it's debt minus cash. They have a really low leverage ratio. Leverage ratio is EBIT over debt. Above 9% is good. They're at 10%. Revenue is down 63% year over year, but quarter over quarter, when you compare fourth quarter 2022 to first quarter 2023, it's down 37%. Adjusted EBITDA is down 62% quarter over quarter. Adjusted EBIT and net income are negative, so we can't really compare to prior quarter or prior year. Here's the volume breakdown in case you were curious. In the Pacific, it's 274,000 units. That's down a little bit from 285,000. Cross Suez is up from 94,000 to 116,000. Atlantic is down quite a bit from 155 to 109. Intra-Asia is also down from 269 to 219. All these numbers are in thousands. I'm just saying the number to make it easier. Latin America is down a little bit from 56 to 51. They had a cash outflow of $353 million in the first quarter. The way that came about is they had $174 million of cash flow from operations. They spent $32 million in CapEx, so their free cash flow is positive $142 million. They had to service their debt, pay the interest on their debt, $482 million. They paid down $21 million in short-term loans, and they had a positive $8 million from other. This is how they're reaffirming their 2023 guidance. They think freight rates will be significantly lower, which I agree with. Carried volume will be higher, and bunker rates will be slightly lower. I'm not sure if they can hit these targets if these three things are correct, especially freight rates. This slide talks about oversupply in 23 and 24 expected. That's the determination of freight rates, supply and demand. When there are too many ships out there in the market, too much supply, then prices go down. But when ships start to scrap, there's less ships in the market, supply is low, and rates go up. If you want to be technical, it's not really how many ships in the market, it's how much capacity. Those two things aren't always the same. There are a lot of similarities between how many ships in the market and how much capacity, but if there's a lot of smaller ships in the market, compared to a market with a lot of big ships that can hold lots of cargo, that does affect things. The blue bars are fleet capacity, and you can see that goes up little by little each year. It's about 18 million units in 2014 to about 23 million units in 2022. Now let's look at their financial statements. This is as of the first quarter 2023. The first financial statement they show is the balance sheet. Their biggest asset is their vessels. That was $4.8 billion. That's the book value of the vessels. That's their theoretical worth in open market. That's up from $4 billion in 2022. So it looks like they added some ships. 1.2 billion of containers, down from 1.3 billion. Other tangible assets, 98 million. There's a footnote if you want more information. So here's footnote 6. These are actually right-of-use assets. So these are assets owned by another company that they lease from them. So it's carried on their balance sheet as if they own it. Since they do not own these assets, the vessels and containers, we'll see a liability in a similar amount. 95 million of intangible assets. This might be goodwill. They invested 23 million in other companies. Other investments, 1.3 billion. They have 113 million in long-term receivables and 2.9 million in deferred tax assets. A deferred tax asset will result in a tax credit sometime in the future. You'll see that tax credit on the income statement. Companies that follow IFRS show non-current assets, then current assets. Companies that use GAAP, US companies, it's the opposite. They show current assets, then non-current assets. In the US, on the balance sheet, it's most liquid to least liquid. They do the opposite for IFRS. They have 189 million of inventory, accounts receivable 695 million. This is how much money other companies owe them. Other investments, 1 billion, and cash, 1.9 billion. So total current assets are 3.8 billion. And you could see it's higher than current liabilities, so they have a current ratio above 1. They have 3.2 billion in current liabilities. Next is the equity section. Share capital is how much money they raised from selling equity, 2 billion. Retained earnings is a sum of all their prior net incomes minus the sum of the dividends they paid out. And that's 3 billion. Of course, it's down from the last quarter, but up from a year ago because they had high retained earnings before the first quarter of 2023. The second, third, and fourth quarter were really strong. So total equity is 5.1 billion. They have 3 billion in lease liabilities. They're leasing the vessels. And these are lease payments due beyond 1 year. They have 1.5 billion of lease payments due within 1 year. 88 million of loans. This could be a loan from a bank. 43 million of employee benefits. And 145 million of deferred tax liabilities. At some point, a deferred tax liability will be put onto the income statement and increase the company's taxes. They have 3.3 billion in non-current liabilities, 1.4 billion in payables. This is how much money they owe other companies from buying on credit. 52 million of provisions, 195 million of contract liabilities. This is similar to accounts payable. And 74 million of loans. 3.2 billion of current liabilities, down a lot from last year, up a bit from last quarter. Total liabilities, 6.4 billion. Here's why the stock went down so much today. Their income from voyages was only 1.4 billion, down from 3.7 billion. And last quarter, it was 12.6 billion. Then they have 939 million of expenses, 380 million of depreciation. They barely squeaked out a gross profit. Last quarter, they had a gross profit of 6.4 billion. Margins above 50%. Last year, 2.3 billion. Their margins are about 65%. 74 million in general and admin expenses. So they had an operating loss of 14 million. They spent 95 million of interest on their debt, a lot lower than last quarter of 239 million. They did get an income tax rebate of 6.6 million. So their net loss was 58 million. Even though they had an accounting loss of 58 million, they actually generated 173 million of cash flow. Because there's a lot of non-cash items on the income statement, like depreciation and amortization, 387 million. They had a positive 143 million from receivables. This means they extended credit in the past. Like last year, they extended credit of 96 million. So they supplied a product or service, but didn't receive money for it. So it's a cash outflow when they extend the credit, but when the customer pays, it's a cash inflow. On one of my quizzes recently, I said dividends paid show up in cash flow from financing, but dividends received show up in cash flow from operations. So they received 100,000 of dividends on their investments. They received another 50 million of interest on their investments. So that's how they got positive operating cash flow. But still, it's nothing, 170 million compared to last quarter of 6.1 billion. In their investing section, they spent 36 million in CapEx. Last quarter, they spent 345 million. This is to acquire new vessels. They invested 160 million And they sold $1.4 billion of investments. This is mainly cash deposits, like commercial paper or bonds. They generated $1.2 billion from their investing section. In their financing section, they had a cash outflow of $509 million. They paid back $395 million on lease liabilities and borrowings. They paid back $21 million on short-term loans. They didn't pay any dividends to common shareholders. Last quarter, they paid $3.3 billion of dividends. So they had a cash inflow of $870 million in the first quarter. Here's a breakdown of their revenue by location. In the Pacific, it's $429 million. Cross Suez, it's $171 million. Atlantic, $217 million. Intra-Asia, $161 million. And Latin America, $92 million. Other revenues of $305 million. That's from demurrage and value-added services. So that's the end of the video. Please give a like, comment, or subscribe. Talk to you soon.